Welcome to Cyber Explorer, your go-to channel for reliable tech insights and cyber trends. Have you ever been enticed by an app promising automated trading profits or sky-high interest rates, only to watch it collapse, revealing itself as a Ponzi scheme or a platform crippled by reckless risk management? Danger of unregulated investment platforms in the digital age. Please leave your comments below in the comment section after watching this video. Over the past 2 decades, financial markets have undergone a profound transformation driven by digital technology. Traditional investment intermediaries such as banks, brokerages, and regulated exchanges are no longer the sole gateways to investing. In their place, a rapidly expanding ecosystem of online investment platforms has emerged, offering access to stocks, cryptocurrencies, foreign exchange, derivatives, peer-to-peer lending, and alternative assets with unprecedented ease. While many of these platforms operate under established regulatory frameworks, a growing number function in legal gray areas or entirely outside formal oversight. The rise of unregulated investment platforms has reshaped how individuals participate in financial markets, but it has also introduced significant risks for investors and regulators alike. Unregulated investment platforms can be broadly defined as digital services that facilitate investment activity without being fully subject to the licensing, disclosure, consumer protection, or supervisory requirements imposed by financial authorities. These platforms often exploit regulatory gaps created by rapid technological change, jurisdictional fragmentation, and inconsistent global standards. Their growth reflects both legitimate demand for innovation and access, as well as opportunistic behavior that capitalizes on regulatory uncertainty. Understanding why these platforms have proliferated, how they operate, and what risks they pose is essential to evaluating their long-term impact on financial stability and investor protection. Drivers of growth. One of the primary drivers behind the rise of unregulated investment platforms is technological advancement. Cloud computing, mobile applications, blockchain infrastructure, and algorithmic trading tools have dramatically reduced the cost of launching financial services. What once required significant capital, compliance teams, and physical infrastructure can now be achieved by small teams operating across borders. This technological democratization has enabled rapid experimentation but has also outpaced the ability of regulators to respond effectively. Another major factor is investor demand for accessibility and higher returns. In many countries, traditional investment channels are perceived as slow, expensive, or exclusive. Younger investors in particular are drawn to platforms that promise low fees, instant account creation, and the ability to trade complex instruments with minimal barriers. Unregulated platforms often market themselves as alternatives to outdated financial institutions, emphasizing freedom, decentralization, and empowerment. In an environment of low interest rates and economic uncertainty, the promise of outsized returns becomes especially compelling. Globalization has also played a critical role. Digital platforms can operate across national borders with relative ease, allowing companies to base themselves in jurisdictions with weak or ambiguous regulations while targeting users worldwide. Regulatory arbitrage, the practice of exploiting differences between legal systems, has become a defining feature of the modern financial landscape. Platforms may argue that they are not subject to specific regulations because they do not fit neatly into existing legal categories, such as exchanges, brokers, or investment advisors. Finally, regulatory lag itself contributes to the problem. Financial regulation is often reactive, developed in response to past crises rather than emerging innovations. Legislators and regulators must balance investor protection with the desire to foster innovation, a process that can take years. During this time, unregulated platforms can grow rapidly, accumulate large user bases, and become politically and economically difficult to shut down. Types of unregulated investment platforms. Unregulated investment platforms are not a homogeneous group. They span a wide range of business models and asset classes. Some focus on speculative trading, such as high-leverage foreign exchange or derivatives platforms that target retail investors. Others facilitate investments in novel or illiquid assets, including digital tokens, collectibles, or real estate-linked instruments. Peer-to-peer lending platforms may connect borrowers and lenders directly without complying with banking or securities regulations. In each case, the lack of oversight allows platforms to operate with fewer constraints than regulated competitors. A particularly prominent category involves platforms that blur the line between investing and gambling. By incorporating game-like features, social trading elements, or aggressive reward systems, these services encourage frequent trading and risk-taking. Without regulatory requirements around suitability assessments, risk disclosures, or advertising standards, such platforms can expose users to losses they do not fully understand. It is important to note that not all unregulated platforms are fraudulent. Some are genuinely innovative services operating in areas where regulation has not yet been clearly defined. However, the absence of oversight creates an environment in which misconduct can flourish, and even well-intentioned platforms may fail to manage risks adequately. Risks to investors. The most immediate concern associated with unregulated investment platforms is investor protection. Regulated financial institutions are typically required to meet standards related to transparency, capital adequacy, data security, and fair dealing. They must disclose risks, segregate client funds, and provide mechanisms for dispute resolution. Unregulated platforms, by contrast, may not be subject to any of these obligations. This lack of protection exposes investors to multiple risks. Fraud is a significant threat, as unscrupulous operators can misrepresent investment opportunities, manipulate prices, or simply disappear with client funds. Even in the absence of outright fraud, platforms may engage in practices that disadvantage users, such as opaque fee structures, conflicts of interest, or misleading marketing claims. Operational risk is another concern. Many unregulated platforms lack robust risk management systems, cybersecurity protections, or contingency plans. Technical failures, hacking incidents, or internal mismanagement can result in sudden losses for users with little recourse. In regulated environments, authorities may intervene to protect clients or ensure orderly wind-downs. Such safeguards are rarely available in unregulated contexts. Information asymmetry further compounds these risks. Retail investors often lack the financial literacy needed to assess complex products or evaluate platform credibility. Unregulated platforms may exploit this gap by emphasizing potential gains while downplaying or obscuring risks. The use of influencers, social media marketing, and referral schemes can amplify these effects, creating herd behavior and speculative bubbles. Systemic and market risks. Beyond individual investors, the rise of unregulated investment platforms poses broader risks to financial markets. As these platforms grow in scale and interconnectedness, their activities can contribute to market volatility and systemic instability. High-leverage trading and speculative behavior can exacerbate price swings, particularly in less liquid markets. Unregulated platforms may also undermine confidence in the financial system as a whole. High-profile collapses or scandals can erode public trust, even in regulated institutions. When investors suffer losses on unregulated platforms, they may call for government intervention, creating political pressure and moral hazard, despite the absence of formal oversight. Additionally, the opacity of unregulated platforms makes it difficult for authorities to monitor market activity and assess risks accurately. Without reporting requirements or supervisory access, regulators may be unaware of emerging threats until they reach a critical point. This lack of visibility complicates efforts to maintain financial stability in an increasingly complex and digitalized market environment. Regulatory challenges. Regulating unregulated investment platforms presents significant challenges. One key issue is jurisdiction. Digital platforms often operate across borders, making it unclear which regulatory authority, if any, has responsibility. National regulators may lack the legal tools or international cooperation mechanisms needed to enforce rules against offshore entities. Another challenge lies in classification. Existing regulatory frameworks are typically organized around specific types of institutions or products. Innovative platforms may not fit these categories, allowing them to argue that regulations do not apply. Crafting new rules that are both flexible and enforceable requires careful legal and technical analysis. There is also a tension between innovation and protection. Overly restrictive regulation could stifle technological progress and limit access to financial services, particularly for underserved populations. Conversely, a hands-off approach risks leaving investors exposed to harm. Finding the right balance is one of the central policy debates surrounding unregulated investment platforms. Potential policy responses. Addressing the risks associated with unregulated investment platforms does not necessarily require banning them outright. Instead, many experts advocate for adaptive regulatory approaches that focus on activities rather than institutions. By regulating what platforms do, such as custody of funds, provision of investment advice, or use of leverage, authorities can apply protections more consistently across different business models. International cooperation is also essential. Given the global nature of digital finance, harmonizing standards and sharing information across jurisdictions can reduce opportunities for regulatory arbitrage. Improved investor education can complement regulatory efforts by helping individuals make more informed decisions and recognize warning signs. Finally, regulators may explore the use of regulatory sandboxes and innovation hubs. These mechanisms allow new platforms to operate under limited supervision while rules are tested and refined. Such approaches can encourage responsible innovation while maintaining a baseline level of investor protection. Conclusion: the rise of unregulated investment platforms is a defining feature of the modern financial landscape. Driven by technological innovation, investor demand, and regulatory gaps, these platforms have expanded access to investment opportunities while simultaneously introducing new risks. For individual investors, the lack of oversight can lead to significant financial harm. For markets and regulators, unregulated platforms present challenges related to stability, transparency, and trust. As digital finance continues to evolve, the question is not whether unregulated investment platforms will exist, but how they will be integrated into the broader financial system. Effective responses will require adaptive regulation, international cooperation, and a nuanced understanding of both the benefits and dangers of innovation. By addressing regulatory gaps without suppressing progress, policymakers can help ensure that the future of investing is both inclusive and secure. Don't forget to leave your comments below. Thanks for watching. Like, share, and subscribe to Cyber Explorer for more updates. See you in the next video.